Let's go.
Here we go. I apologize. I apologize in advance. You know, due to the melanin in my skin, sometimes I might run like 1 or 2 seconds late. Please forgive me. Please forgive me. You feel me?
Listen, it's a blessing to be here. It's a blessing to be here.
You know what I'm saying, man? Prayers out to all my Gulf Coast cousins. I know y'all going through a lot right now, so I just want to take a chance to make sure we pray for y'all and just know we thinking about y'all. I got family in the Gulf, so you know that's very near to me. I know you do too down there, so we praying for y'all right now. Make sure y'all stay safe. We is running a little behind, so we're gonna get right into it. We had a semifinals last week, AJ. Man, that was
man on my baby too. Goodness gracious.
You could tell they was trying to go to the championship, you know.
Man, what? But of course, you know, we had a winner. We had to have a winner. So
who won that?
Man, the Micron Bear won that. David himself, man.
Wow, David moves on.
David
solo,
moves on, man. Solo dolo.
He's been killing it. I could respect that, man. That's huge. I could definitely respect that. So
that is.
Shout out to David, man. You will be going up against Leah and Dave on September 12th. So next week, we're going to take off. It is Labor Day weekend, so we want to make sure that, you know, we're not taking up y'all time trying to get people in here on a holiday and stuff. So make sure y'all spending some time with the family. You feel me? Get off the computer. Go spend some time with your kids that, you know, you don't never holla at. But yeah. And then, so September 12th, that week after that is when we will have the finals. You want to tell them what company we doing?
Hey, listen, a lot of us slept on this company, bro. Like this company, like out of the pick list, this company has been running. Like if you had a leap in this company, bro, I swear you would have walked away this year.
Nah, definitely.
We are doing Fortinet, y'all. FT&T.
Fortinet. So we will be doing. We will be doing a bull bear case on Fortinet. So if you've never looked at FT&T, you just keep hearing about the 52-week highs. This time you will be able to see just the actual fundamentals behind the business, because we hear about the performance all the time. We never really got a chance to do a good fundamental analysis on it, just as, you know, the cousins. So we will have Leah, Dave, and David breaking that company down for us. I'm excited for that.
Man, what? Everything going on with cybersecurity right now and these hacks and stuff, this is going to be a real good one.
Yeah, we're going to see who walk out the ring victorious for that.
And it just keep running.
Man, I don't even want to talk about it. But yeah, y'all, so this week we doing something a little different. We don't have a bull versus bear case this week, so we will be doing actually a presentation with me and AJ.
Okay.
So y'all get to see something never seen before, where we do one together. You feel me? I'm gonna put my spectacles on so we can get serious.
You know, it's just one of those nights, you know.
Man, come on, listen.
Nights.
We gotta get right.
You know.
We gotta get right. So without further ado, we will be breaking down the sectors, giving a little bit of information on them, giving some background, basic information for people who missed season 1, where we did go through and break down all of the sectors. So we're gonna be doing that today. We're gonna try to fit as much information as possible. We don't want it to be too long and drawn out. But again, this video will be here. It will stay up on here. I will timestamp it as well, so y'all will have it as a reference in the future to come back to. If you guys do want us to expand on it in the future and go deeper, Let us know if it helped. Let us know if there's something we could do better. Let us know. Because me and AJ about humble as they come. We ain't trying to be, the biggest, baddest guru out here. If y'all got some additional information, please throw it in the chat. If we say something wrong, please correct us in the chat. We here to learn together. We more of like, this is like a peer-led presentation than a mentee type of thing. You feel me? Am I right, AJ? Did I hit that on the head?
Man, you hit it right on.
All right. All right, cool. See, I know me and you be, so all right, we're gonna get right into it. Let me get my steps set up on this side.
Oh, this is gonna be good though, because I know all of us, we got hit by just being heavy tech. So
heavy tech.
All need to start researching and looking outside of tech for opportunity.
That is a super fact, especially with September coming up. So let's go ahead.
We're gonna take it back to the basics right quick.
The basics. Now y'all bear with me. This will be my second time sharing on Zoom. So listen, man. Okay. So I'm gonna share this. We're gonna go boom right here. Share. Let me know if you can see that, AJ.
I sure can.
Okay.
I can break down the 11 sector overview.
We'll go present. Boom.
Yeah, we rocking.
All right. So what I'll go ahead and do, we'll hit next. Now, AJ, you could go ahead and take this one.
Bet. So let's just cover what is a sector. So like we stated, there are 11 sectors, and the sector is simply an area of the economy in which businesses share the same or related business activity, product, or service. Sectors represent a large grouping of companies with similar business activities. Why are sectors necessary though, right? Dividing an economy into different sectors helps the economy analyze the economic activity within those sectors. So sector analysis basically provides the indication of the status of the economy from various points of view. They are also useful for comparison purposes when analyzing individual stocks as well.
So as far as like how these sectors came about, so basically there's 3 different classification systems. There's the ICB, the GICS, and the TRBC. All 3 of them use different approaches. Usually they're based on these 2 different approaches right here. So you have the production-based approaches where they focus on the processes that a company uses to manufacture its products. So for example, Rolex and Lululemon may have very different target markets and products, but they're both produced in a manner that's consistent with the consumer goods classification. So essentially in this approach, they're saying, hey, we know you're selling different things, you're selling them to different people, but at the end of the day, you are selling a good to a consumer. So that is the classification you will be in. Now, other classification systems use a market-based approach where they focus on the market that a company services rather than its products. For example, Google and Microsoft have completely different products, but they'll both fall under information technology due to their similar target markets, which is corporations using technology for business. Now, that would be the market-based approach. In some instances, you will see Google classified as a communications company. That would be a production-based approach under that classification. So the ICB is the industry classification benchmark. It's created by the Dow Jones. It's used by the NASDAQ and the New York Stock Exchange, and it is the most simple of the classifications. Then you have the global and industry classification standard. That's the GICS. It was created by the MSCI and the S&P, the Standard & Poor. It is used by the S&P and the MSCI indexes, of course. And this is the one that's most recognized among investors. So this is the one that the SPDR ETFs are classified by. This is the one, if you go on, basically like CNBC, if you look at their sector analysis breakdown. It's usually in the GICS. And then you have the Thomas Reuters business classification, created by Thomas Reuters. It's used by the Thomas Reuters indexes. And this one is the most complicated, the most specific, because it actually classifies over 70,000 global companies. So it has a lot of different subsectors, a lot of different just bits and pieces to classify different things to basically analyze information more specifically. You could go ahead and just give them a rundown, AJ.
All right, bet. So like we said before, there's 11 sectors. Information technology, we all know. Healthcare, consumer discretionary, communication services, financials, industrials, consumer staples, real estate, utilities, materials, and energy. And now we're going to go into a breakdown of each of them.
Hey, let me know if this closes it out real quick. I just want to see something. Can you still see my presentation?
No, it closes it out.
Got you. Matter of fact, do you think you could share?
Yeah.
Because I have to look at something.
No problem.
Bear with us, y'all.
Let me pull it up right quick.
Just want to make sure y'all get all the information, that's all.
Let me pull it up on Canva and then we can share it. So let's see. All right, allow me to share, bro, and then we should be good to go.
All right, boom, there you go.
Yeah. Excellent. All right. Just got to skip ahead. All right, so I think we were here, right?
Yep.
All right. So first one we're going to go over is information technology. All right, consists of three main industries that offer software, IT services, hardware equipment, and semiconductors. All right, everybody loves SMH. Market cap 16 trillion, volume 1.4 billion, represents about 27% of the S&P, right? So it's one of the heaviest weights in the S&P out of all the sectors. Historically has the highest returns over time, highest PE ratios, but of course that comes with a lot of volatility. This is one that we consider risk on, so it falls under your cyclicals. And it's interest rate sensitive and economically also sensitive. So when you start looking at the business cycle, this is one that falls in the economically sensitive, interest rate sensitive section. The biggest stocks, though, as we all know, are Apple, Microsoft, and NVIDIA. And we got the come up pick list, but we got some homework for y'all at the end. So we left that blank. Spider ETF, XLK, and the 1 year performance was 29.4%. Year to date, 21.5, 3 months, 14.6. So that just shows you overall, if you would have just invested into IT, what some of the performance gains you could have experienced would be year to date and over a 3 month period of time.
Mm-hmm.
All right, let's move on. There we go. All right, T, you want to cover this one?
Yeah, so healthcare, it consists of two main industries. You have healthcare equipment / services and pharmaceuticals / biotechnology. So healthcare, of course, you have the hospitals, you have people that sell equipment to the hospitals, you have the people that sell the medicine, the vaccines, the the different cures and biological, the tests and all of that stuff. This one has a market cap of about 8.48 trillion. So it's about half the size of tech, but it still gets a pretty good amount of volume at 1.34 billion. Now it represents about 13% of the S&P 500. And healthcare actually does have historically the most consistent returns over time. It has low PE ratios, low volatility. It is considered an economic necessity, so it is a risk-off sector, and it is considered defensive. So essentially, it is almost like the opposite of, I wouldn't say the opposite, but it's a lot different than the tech sector, where you're going to experience a lot of volatility, a lot of highs and lows, a lot of swings over time. Where if you look at XLV's chart, it's a lot more subtle. It's just steady uptrend. You feel me? And then the biggest stocks are going to be J&J, UNH, and PFE. Shout out to everybody that, you know, has been dabbling in those stocks. I know they've been giving some good returns. And then, of course, the come up pick list is blank, because you guys will be doing that portion. And then the Spider ETF is XLV. 1 year performance is 24.9%. Year to date is 18.7%. And 3 months is 9.4%. So as you can see there, nothing crazy, nothing out of the box, but some solid returns from XLV in the short term here.
Facts. And keep in mind, guys, when we say risk off defensive, that means, you know, where people run to when they want something safe, right?
Exactly.
Like T said, it doesn't experience as much volatility and back and forth, up and down, like some of your tech stocks do.
Exactly.
So that's why people consider them safe investments. All right, consumer discretionary is next. All right. Don't we love XLY? So this consists of 4 industries, which are automobiles components. Hence, y'all, why our baby Tesla, well, let me not say our baby. Not everybody's a Tesla. Listen, Tesla's ruffled some feathers. It is on people's no trade list at the moment. But we're going to work on that. We're going to work on that this year. Consumer durables apparel. So when you think of like your Nikes of the world, right? And other apparel companies, you think consumer discretionary. Consumer services and retail stores, right? So hence, Home Depot. I know we had some Home Depot cousins hit big this year on some Home Depot contracts, taking advantage of what was going on in the real estate market, and the you know, the uptick in people wanting to fix and renovate their homes and stuff and invest in the Home Depot. So it represents about 12% of the S&P 500, historically performs best during economic recovery, and has high PE ratios and high volatility. It's considered risk on, so cyclical, and also, like we said, interest rate sensitive and economically sensitive. So hence why it performs best during economic recovery. Biggest stocks: Amazon, Tesla, and like we talked about earlier, Home Depot. You can find it by using the Spider ETF XLY. And the performance 1 year, 21.6, year to date, 13.1, and 3 months, 5.1. So, you know, Amazon and Tesla haven't even took off yet. It's going to be interesting. We're going to see. We're going to see.
We're going to see what that seasonality look like too here in a second, see what we're working with.
Uh-oh. Okay.
All right, boom. So this one is the communication services. Consists of 2 main industries. So you got your telecommunications. So that's going to be like the T-Mobiles, you know, the phone companies, Sprints, things like that. And then you have media entertainment. So Viacom, Netflix, Disney. So there's 2 totally different parts to communications, what makes it kind of a weird sector, but don't sleep on communications, man. The market cap is pretty big as well, 8.48 trillion, some good volume there as well. Now, it represents about 11% of the S&P 500. It has gone through recent changes, so the current structure of the sector does not have accurate history. It did used to be like, I think, the telecommunication services sector only. It didn't have media and entertainment. So it definitely has done some restructuring. So if you go back and try to find like historical performance or things like that, you're not really going to find that past, I want to say like 2008. But it does have high PE ratios. It is highly volatile. It is economically sensitive. It is a risk on sector as well. And now I put stars next to cyclical because in general, it is a cyclical sector. However, as time goes on, analysts are starting to notice that it is coming a little bit more defensive, especially if you see the recovery that we had from the market crash that we had. Communications actually was right up there with financials as far as who's going to be the number one performing sector coming out of that. So a lot of our communications have moved from something that people will not pay for during a recessionary period to now a little bit more essential. So you do have stuff like Disney and stuff like that, where their parks and stuff will get cut out, but people are still going to be using Facebook. People are still going to be using Google. People are still going to be using their phones, no matter what time period it is. It doesn't matter if you dead broke or you got money. So it can, as time goes on, that might, become a defensive sector, or just in the middle where it does have cyclical stocks and it does have defensive stocks, and whatever the economy is at the time will take it, where it takes it. The Spider ETF is XLC, and then you see the performance over 1 year, a solid 33.6%, year to date 25.6%, which is very impressive, and then 3 months 6.4%.
And to your point, bro, y'all go back and look at how Google stood strong through this past recession. Go back to the charts and look at that, okay?
XLC been doing this thing on the low.
Yeah, it stood its ground. That's a fact. All right, let's move on. So financials, right, consist of three main industries. So you got your banks, insurance, and diversified financial. All right, has a market cap of 8.91 trillion and volume 653 million. Represents about only 12% of the S&P 500 and historically performs best during economic recovery. So that's when you're interest rate sensitive and economically sensitive. Low PE ratios, high volatility, risk on, and also cyclical. Some of your biggest stocks, you got the Berkshire. All right, so that expensive, man. Every time I think about Berkshire, I'm just like, that Omaha stuff. You know what I'm saying?
You feel me?
We're going to keep it moving though. JP Morgan and BAC. It just makes me upset, man.
Yeah.
You can find it under the Spider ETF XLF. But y'all, look at this performance 1 year though. Like, this is why I say we can't just look at tech. If you would have just set your tail in a leap for XLF,
man, listen, man.
Everybody was XLK, XLY, when nobody talking about XLF.
So
you had 54.4% for your performance, right? That's a year to date of 32.3%, y'all.
Mm-hmm.
Wow. Now, yes, it's underperformed the last 3 months, but still, just put it into perspective, right?
They already got their money.
Right.
They already got their money. You feel me? Because what happened was them stocks had got sold off so hard during the corona that when the money started pouring in, that's easy money. Like, a lot of those banks and what was it, Goldman Sachs?
Man, leading the way. No, Zay baby, leading the way. Y'all, Goldman Sachs part? Listen.
Listen, you say it 5 times, they might pop up on this.
It's disrespectful. It's disrespectful. But no, that's definitely a sleeper though. Y'all keep y'all's eyes on Goldman Sachs moving forward. Seriously though.
Yeah. Nah, for sure. And JPM is that's a come up pick. So listen, do your thing, man. This like
MasterCard, like
right. Like this like when you thought your parents was cool, and then you see like the other parents getting their kids a full pantry of snacks. You feel me? They got a car as soon as they turn 16. Like that parent right here. You feel me?
No, for real. Like you just gotta keep you just gotta go stay for the weekend. You know what I'm saying?
Yeah, like let me stay. Let me stay for the weekend.
Stay for the summer, you know what I'm saying? Might swing me for a couple, but listen, we can't sleep on XLF, y'all. We can't.
That's a fact.
We
that
can't.
Is a whole fact.
Can't do it. All right, bruh, industrials. This is another one.
Industrials. So this one consists of companies. I thought, matter of fact, side note, I thought this dude picture was funny. That's why I put it on there. But
I'm gonna mention that, but I'll let you rock.
So industrials, it covers a wide range of companies. They're typically companies that do not deal directly with consumers. They usually supply the company that then deals with the consumers. So they're not really broken down into like the other sectors just because there's so many different pieces. So they just have so many different subsectors and industries, some consisting of aerospace and defense. You got building products, construction, engineering, industrial equipment, commercial services, air, freight, logistics, transportation, infrastructure. So all of that stuff. 5.95 trillion market cap, 457 million volume. They represent about 8.5% of the S&P. And historically, they do perform best during economic recovery. So this sector is very, very economically sensitive because you got to think if the economy is in a recession, the demand is going to be very low, which means that the people that they supply to are not going to need those supplies, which can heavily affect this sector, which does make it volatile. It is risk on and it is cyclical because you're not going to get a consistent return from industrials over time, just historically though. And matter of fact, before we continue, we forgot to side note, me nor AJ is a financial advisor. We not your parents. AJ don't have no kids. Listen. My kids, I can see them right here and they don't have YouTube chat on right now. They're not watching YouTube. So I know for sure I'm not none of y'all daddy. So if you make any decision investment wise, it is not based upon this. It is based upon your own decision. We're here for information, entertainment. We don't really know anything. So take everything we say with a grain of salt and do your own research to double check anything that we say. Even these facts on here, the presentation look cool and all that, double check for real. Because at the end of the day, if you make a move and you lose or win money, you're going to have to sleep with that at night. You feel me? So let's just make sure we say that. The biggest stocks in industrials is UPS, Honeywell, and UMP. And then the Spider ETF is XLI, of course. The year performance is 34.4%. Year to date is 18.5%. And then 3 months is negative 0.2. So it's been flat for the past 3 months, not really getting a whole lot of love. It has been having some volatile swings due to the industrial news bill coming out. So you just got to kind of watch this sector right now. It doesn't seem like it really knows where it wants to go.
Right. Definitely pay attention to it though, because it does have aerospace and defense, and with everything going on over there in the Middle Seas, dealing with the oil and stuff, this could be something to pay attention to. But like we said, we don't know nothing, so keep that in mind too. All right, moving on. Consumer staples. All right, so this consists of 3 main industries. You got staples retail, food, beverage, tobacco, and household personal products. So when you think consumer staples, you actually think of like things people actually need, right? So I always thought it was crazy how like alcohol companies and tobacco was always considered
right.
You don't leave that alone.
That's wild, right?
It's crazy. I was like, really? I'll get the household and personal products, food and beverage, but alcohol, tobacco? All right. Market cap, 4.61 trillion, y'all. Volume, 106 million. Represents only about 6% of the S&P 500, but it's definitely something to pay attention to when it comes to, wanting something economically essential and defensive, right? This is a good defensive play. Like, for instance, when COVID hit, right? Everybody still had to buy the essential things to, make it day to day, and people were hoarding them, right? So this was actually a good play to look into when it came to something like that. So keep that on your watch list for when, we have those type of health scares and stuff like that arise. Historically consistent returns over time, low PE ratios, low volatility, like we said, risk off, defensive. Biggest stocks, you got Walmart, Procter and Gamble, PG, all right, KO. Spider ETF, y'all, XLP. Okay, so it's XLP. Performance 1 year, only 10.1%. Year to date, 6.4. 3 month, 1.6. But keep in mind, y'all, 10% is still consistent. That's still, it's not the sexiest thing out there, but when it comes to being defensive and protecting yourself, 10% is nice. So keep that in mind as well. You want to add anything to consumer staples, bro?
I mean, it's nicknamed consumer defensive. So, when the economy goes bad, like AJ said, when the corona was happening, I went to the store, you couldn't find toilet paper for like 2 months in the store. I hope people did whatever they had to do to, continue to take care of business. But these are companies that will get money year round, rain, shine, or storm. The only reason that they might have down periods or they might have downturns is if other sectors look more attractive, because they're not going to move as quickly as, high flying tech stocks. So if it's a fully recovered economy where high flying tech stocks can, do their little dance in the rain, then people are going to run to those, and they might shed some of the money from consumer staples. But guarantee, when all the party is over, they're coming right back home to these. So always got to keep these on your watch list for a rainy day.
Facts. And you just keep your eyes and ears open to what's going on in the open interest and volume. You might see another one of them Greek Delta Lambda viruses appear, and somebody might know some news you don't know. So you just pay attention and see what you can see. That's what I use it for. So keep your eyes on it, y'all.
Mm-hmm.
Real estate. So we all know, right? Low interest rates. Real estate was popping, right? Real estate was popping. So consisting of two main industries, you got REITs and real estate management / development. All right. So market cap 1.74 trillion, volume 228 million, represents about 2.5%. So kind of like consumer staples, it's a small percentage of the S&P, but returns are based around the status of the economy. All right. So like we said, right now, rates were low, right? That encouraged people to want to go out to borrow money to fix up their homes, to, buy homes, right? We saw a surge in that. So high PE ratios, high volatility, economically sensitive, interest rate sensitive, like we stated, and cyclical. Your biggest stocks, you got AMT, PLD, CCI, and of course you got the Spider ETF, XLRE. All right, it's only 4-letter one, so you can't forget it. 29% performance 1 year, year to date, 25.4%, my apologies, and 3 month, 9%. So depending on how interest rates are, this is also something to keep in mind, depending upon what the economic conditions are at the time, right? And you're going to get into more about market cycles and understanding the economy and how to invest accordingly a little bit later. So tie it all together. All right, moving on.
All right, so utilities consists of one industry. This is not some sexy, got all type of shenanigans going on. It's a very, very, very basic sector. They do have different little sub-industries like electrical utilities, water utilities and all of that. But the market cap is very low. It's 1.66 trillion. Volume is very low, 105.6 million. Represents a very small 2%, 2.5% of the S&P 500. The returns are historically low, but consistent. So you're not going to get a lot of volatility. You're not going to get any high PE stocks. It is a risk-off sector. It is essential. No matter what economy we are in, people are going to have to pay their utilities. Rain, sun, shine, snow, whatever, they're going to have to pay their utilities. So it is a defensive sector. The biggest stocks in that sector are NEE, DUK, and SO. Performance you see there, it is an XLU, so the performance 16.3% for the year, 9.3% year to date, and 3 month 5.7%. So it does look like we got some defensive rotation going on with 5%. That's actually kind of high for this type of sector. So just be looking out to see why is the money going there? Why was it going there? Who is going there? You know, look at some what is it, the 10Fs, 10Ks, all of that stuff. So just make sure y'all are paying attention to something like that. That is actually kind of interesting.
Yeah, we're gonna look at that sector seasonality too. It was a nice little summer play that did well.
Mm-hmm.
Mm-hmm. Very nice. But yeah, we'll look at the sector seasonality later. Materials consist of 5 main industries. You got chemicals, construction materials, container packaging, metals and mining, paper and forest products. Has a market cap of 2.74 trillion and volume of 367 million. That represents about 2.6% of the S&P 500. Returns for materials are based around the status of the economy, right? So very similar to how real estate was. This is also one that does kind of does well or not, dependent upon the status of the economy. High volatility, risk on, and cyclical. The biggest stocks are BBL, BHP. So you got LIN, also Rio. Okay. Spider ETF, XLB. Okay, that's for materials. Performance 1 year, 36%. Year to date, 18.7%. And 3 month, negative 1.6%. And I'm pretty sure we gave Val when we did the materials on Sector Sunday, if I'm not mistaken, and that was a nice little pick.
That was
36% performance over a year. We actually gave a nice little materials play for y'all.
Mm-hmm. It was out there, and materials was popping for a minute. It's not been doing good for the past 3 months, but it had a nice little run early in the year.
It sure did. So, all right. Oh gosh, here you baby that you played up and down, up and down.
Listen, man. So we got the energy sector. I'm gonna keep this energy because I did check my E-Trade the other day. This is actually my most profitable.
I knew it.
Position. You feel me? In and out. It does consist of 3 main industries. So you have the energy equipment and services. You have the exploration, production, and refining aspect. And then you also have the renewable energy, which is actually the fastest growing industry of that sector, where the kind of the refining and stuff is taking a little bit of a downturn lately. The market cap is 2.65 trillion, volume 623 million, represents about 3% of the S&P 500. The returns have historically been based around the price of crude oil. So if you look at a XLE long-term chart, it is highly, highly volatile. There's been highs 10 years ago. There's been lows last year. You feel me? So it's not something that you really would want to play a leap in, I would say. But as far as a swing trade, volatility definitely can work in your favor if you do your research and you know what you're doing. It is a risk on trade. Now, this is the thing about energy. So depending on the economy, because economic factors can be different during different recessions, during different recoveries. So energy can be a defensive stock or it can be a cyclical stock. Now, if you're going just purely long-term, it definitely has played as a cyclical stock, but there are economic times where energy will be an attractive defensive sector. And it has been previously. I don't have the exact years off the top of my head, but if you do your research, you will see that XLE has sometimes been played right there with XLU. But it is still sensitive to the economy. The biggest stocks will be XOM, CVX, and then RDS A and B. Spider ETF is XLE. The 1 year performance is 37%. Year to date is 30%. and then 3-month is negative 5.4%. So you see, there was a lot of profit taken, but even with the negative 5% 3-month, it still has a 30% year to date, which is one of the higher year to date sector performances. So you can just see how much it ran earlier this year. And I personally did catch a lot of that. So just keep your eye on that sector, because when it runs, it runs. When it falls, it falls. So it's definitely a good sector to trade if you end up on the right side of that trade.
No, that's a fact. And don't sleep on the gem that, the price is usually based around the price of crude oil. So you can follow that news they be having on crude oil, and they'll kind of give you an idea of how to trade XOE as well. So something to look into.
And crude oil has futures. So just like, ES, go ahead and look up that WTI and start following it.
That's a fact. That's the whole fact. All right, let's move on. All right, so sector seasonality. All right, so like we stated before, this is another thing that you can look at in terms of investing investing with these different sectors. You can look at the seasonality around them. One that stood out to me a lot was, like I said, XLU, and how it performs over your summertime months, right? Definitely something to, go and pay attention to. But just looking at the seasonality of the various sectors also can give you an indication of the best times to kind of look to enter and exit as well.
So yeah, y'all could definitely screenshot both of these just to use for your reference. This is based upon a 15-year period. So it's just averages of the previous 15-year performance. Now you can see just the different ETFs historically what performs the best in these months. Now remember, things can always change. So don't take this like, oh, it's guaranteed I'm gonna play this, I'm gonna get my money, because it's an average over 15 years. So you're just looking at what's the highest probability, and trading is always that. You're looking at what is the highest probable thing to happen, and how can I set myself up in case it does happen. So for these upcoming months, we typically do see XLU and XLP perform the highest. That is very, very telling after we just got the information about those being two of the most defensive sectors. So it looks like people start going into hiding in September. And then we got XLK and XLB typically perform the worst in September. And we definitely have seen that for XLK. I don't keep too much track of XLB, so I'm not sure of their typical seasonality, but definitely XLK. So if you do have XLKs or you do have tech stocks, just be mindful. It might be time to hedge. And remember, a hedge is insurance. You're not necessarily looking to make a whole bunch of money. You're not necessarily trying to outperform your long-term trade or your main trade. A hedge is solely so that you do not take a total loss if everything goes bad. You feel me? So just be mindful of that when you are hedging or playing puts on against a longer term position.
Correct. To make sure, guys, you understand that what we're saying in terms of how the economics, in terms of the macro level, right, and the global economics affect some of these sectors. So when it comes to seasonality, or when it comes to you buying puts and stuff on things, make sure you do your research, right? Because we all know there's differences between pullbacks and corrections, right? So we want to make sure that some of y'all, make sure you understand what you're planning and preparing for, right? You might not be a correction, right? Make sure you take a step back and look at what's going on in the overall landscape of the economy, so that you can start to understand how to invest and understand when there might be a pullback or a correction or whatever the case may be. But just keep in mind, we don't do nothing. Okay, just keep that in mind.
Hey, can you go back real quick to the last one? Yeah. So everybody that might have missed it and it went too fast, you could take a screenshot. Remember, this video will stay up. So if you miss it again, you can always come back But yeah, so this is all the sectors. This is an average over 15 years of their performance over the different months of the year. All right, we could go.
So when y'all do research, just go back and see like what was going on in the economy for it to perform the way that it did. When y'all go back and look at the charts and things of that nature, try to put together a picture. Bet, defensive versus cyclical. All right, so what is a defensive sector? So defensive sectors tend to be less volatile and steady earners under any economic condition. They tend to actually outperform the market during an economic slowdown, and many defensive sectors offer goods and services that are considered the basics and necessities. So like we said, right, we saw people usually August, September go to utilities, staples, healthcare. These are places where people want to go when they're safe. You think defensive, you can think safety. What is a cyclical sector? Cyclical sectors are volatile and follow trends pertaining to the status of the economy. Many cyclical sectors offer goods and services that consumers buy when the economy is doing well, but cut down during downturns. So you think of technology, consumer discretionary, and energy, right? So defensive sectors, things that people need, right? When everything goes haywire, we're at the worst of the worst, we still need these things, right? Whereas cyclical sectors is kind of like we don't necessarily need these things if things were to go, if the economy were to go bad, right? They become kind of like your wants. So that's another way of how to look at defensive versus cyclical. Some people look at it like growth versus value, right? When you think of your growth technology stocks and things of that nature, right? Things we don't necessarily need versus your value being the ones that are safe, right? And they usually be the things that we need, right? So just different ways that people look, but start to get, as you get familiar with the different sectors, you can put these terms together to match each sector. All right.
Yeah, so this is just basically an example of the defensive sectors versus the S&P 500 over which looks like about a 15-year period. So as you can see, they're pretty much all flat. XLV did outperform the S&P 500, but the other two did underperform the S&P 500, but it wasn't nothing crazy. Like they weren't negative. They weren't, necessarily bad. You don't see a lot of volatile swings in there. One thing I did want to point out was XLU. If you look at that time period where we went through a financial crisis right in there between 07 and 09, that was the highest performing sector. It largely outperformed the market between 07 and 09. And it actually has some volatility in there. You see that triple top where you don't typically see that type of movement in XLU. So you can just kind of see what will happen if we did end up going into a financial crisis. And as they say, there's always a bull market somewhere. So just really keep this in mind, because I'm not an XLU fan, but just being able to understand the history behind this sector, what goes on in times of like real, financial crisis, like there's still money in the market available to be made.
Right. And like we saying, y'all, like these are just things for y'all to keep y'all's eye on. These could be swing trades. Nobody's saying go out here and have leaps on these things.
Yeah,
right?
No.
These are just when things, there's a period of time where we might, experience some downside, right? Because we all know it wants to be bull, right? It wants to be right? Majority of the time. But there's just periods of times where we might need to be defensive, right? And we need to be able to protect ourselves and swing and understand where to go. That's all we're saying. So do your due diligence and understand where to go to protect yourself. All right.
Definitely.
Cyclical sectors versus the S&P. All right. So as you see, the S&P is in black. And of course, charging away in blue, you got XLK. All right. So as we all know, yes, growth always, right? Always, especially when the market conditions or economic conditions are, in its favor, is going to outperform the S&P, right? Hence why a lot of us are heavy tech, right? And are huge tech fans, right? So this is just something to keep in mind. But like I said, don't sleep on XLI. Look at XLI, y'all. Knowing everything we know about the, infrastructure bill and things of that nature that's been signed, like that's a huge catalyst for the next, few years or whatever. So this is something for us to pay attention to, moving forward. So.
And one thing I wanted to point out on this one,
right,
was if you do go back to, because this is like a 20-year chart. So if you go look at the early 2000s and look at the performance that tech had, and then see that slide off that it had when it crashed, the bubble, quote unquote, popped, and tech was underperforming the market on a 20-year for a long time. Like it just started outperforming the market on a 20-year scale when Corona happened in there, like 2019, 2020. So you can just kind of see how the rotation in the market happens, where a lot of us are new, a lot of us are younger, a lot of us haven't been here before, 2018, 2016, maybe. And so we've seen the tech boom, but a lot of investors, especially value conservative investors, after the 2000s bubble, were very scared of the tech space. And you can see that on this chart. And then also, of course, obviously XLE, that that volatility is crazy.
But I mean, major swings though. So
major swings,
right direction.
Right.
These are game changers. These are life changing moves.
Major swings.
Major.
So yeah, that's always one to keep on your watch list and pay attention to.
Facts. All right, T. I'll let you rock out.
All right, boom. So this is something I just wanted to briefly just touch on, just because it is a lot of economic data. I will put the link in the chat for this study. This is actually from Fidelity, where basically they have their analysts do a free study. Even if you don't have a Fidelity account, you can still access it, where they use quantitative and probabilistic data to basically just reasonably identify the state of the business cycle at different points in time. So they say that there's a business cycle every 1 to 10 years. And essentially it just covers the early phase, which would be a recovery, the mid phase, which would be kind of like expansion into peak economy, and then down to the contraction phase where we've peaked, we're tailing off, and then into a recession. And essentially they say we've had about 8 of these cycles since 1962. So this is the data that they had compiled and given out to people for free. So one thing that I want to basically point out on this, so when we're in recovery, they have analyzed that consumer discretionary, financials, industrials, tech, materials, and real estate tend to outperform the market during the recovery period right after a recession. So this would be a period where we're getting stimulus from fiscal policy, the profits are growing, inventories are still low, but the demand is high, so the sales are improving, GDP, employment, income is all rebounding. So this will be a period right after a recession. And then underperforming would be energy, healthcare, and utilities tend to underperform during these time periods. Now, as of Q2, so this is not Q3 data, this will be Q2 where they analyze this. They said that the US was heading into the second phase, which would be the mid phase, headed towards peak economy. Now, one disclaimer that they did give was that these models are not perfect. So there are cycles where you can skip a phase. There are cycles where you can retrace to an earlier one. They do say that down here. So it's not that, oh, Fidelity is saying we're going into peak economy, it's time to go all in on tech. No, this is just an analytical data that you can use to essentially help out and just doing some more due diligence on the market and economics. So during this phase, They say that communications and technology tend to outperform the market, and consumer discretionary materials and utilities tend to underperform the market. Now, let me see. So we get into the late phase. This would be where the policy is contractionary. This would be where you start to see inflation growing. You see supply outgrowing demand, and it looks like we're going into a recession. That's when consumer staples, energy, healthcare, materials, and utilities will outperform the market, and consumer discretionary and tech will underperform the market, of course, because if the economy thinks we are going to go into a recession, people are not going to be out buying extra stuff. They're not going to be spending extra money. They're not going to be buying new iPads and all of this stuff. So those two of our favorites would underperform the market during those times where the market would go defensive. And then recession, obviously we would go full on defensive. So staples, healthcare, utilities are the only sectors that tend to outperform the market. And then, of course, industrials, tech, and real estate would underperform the market. So this just kind of gives you a bull bear during any economic time period, especially in America, but you also do want to look globally, and they do have global data as well on their report. So go ahead, guys, and take a look at that. Like I said, I don't want to go too deep into this. One, because it's already been an hour, and two, because you would actually start getting more into the economics than just the sectors, which is like a whole another topic just about fiscal policy, monetary policy. But that is something that maybe we or Mark and Jolene might cover in the future. But yeah, I just wanted to give you guys this. You can screenshot it. And then I will put the report in the chat so you guys can take a look at that as well. I would go through and read that, especially if you're somebody like me, where I never really paid attention to the economics of the market. I was just trying to find movement. You feel me? Like economics, I just felt like I was going back into school. It's a reason why I stopped going to school. So I was like, But you know, it is in order to play the long game in this, in order to be ahead of the game, in order to be able to do this on your own and not rely on people on Twitter or rely on people on YouTube or rely on a pick or something like that, you're gonna have to know the economics of the market and, you know, just in general. So
it definitely gives you an edge.
It does give you an edge. It does give you an edge.
You know, like when you were talking about cycles within cycles or phases within phases, you know, understanding that macroeconomics, not only within the US, but on a global scale, will help you see those cycles within cycles and phases within phases. So you understand how to protect yourself, or if you just need to get out completely because something else is on the horizon long term, like it will just help with your overall portfolio management if you can get a bigger picture of things. But yes, definitely do y'all's due diligence on that.
And again, that is on Fidelity. So I do encourage y'all. TD has a lot of good analyst information. Fidelity is great. That's my long-term account. That's my kids' account. And the research that they make available for free, even if you don't have an account, is really something that you should look into. So just go on there, play on their site, look at the research, look at the sectors, look at their reports, because they're paying analysts to type up all of this information, gather all of these averages, gather all of this historical data, and make it in a concise, essentially report. And they just give it to you for free. So make sure y'all take advantage of that. And then E-Trade as well does have some reports as well. And then you could go ahead, AJ.
Homework. All right. Sort the come up pick list by sector and analyze the bull and bear case using the economic cycle and seasonality based around the sectors they are in. So, guys, basically, your homework is to basically sum up everything that you've learned tonight, replay this video back, right? And analyze the come up pick list one by one, not only by sector, right? But the bull and bear case, because this is still bull and bear case sector Sunday season, right? Mm-hmm. But also by the economic cycle and the seasonality, right? Mm-hmm. So there's different ways and lenses and viewpoints to look at the market, right? And we want you to make sure that you have a well-encompassed view of everything. So this is your homework. We challenge each of you to do this and to hold each other accountable to make sure that you're, staying studious and constantly learning so that you can ultimately be the best portfolio manager that you can ultimately be.
Mm-hmm. Yes.
Because we are not out here to be relying upon other people. We're just not.
No. And I co-sign that for sure. So one thing I want to say is I know a lot of people got smacked up earlier this year by being tech heavy. And essentially you had to react to the market. So now, the long term didn't really play out how you thought it was going to play out in the moment because a lot of those things didn't even have time to play out. So you started playing short terms. Even myself started playing some shorter terms, get some of that money back, take advantage of the opportunities, take advantage of the choppiness of the market, period, where it kind of killed your premiums every other day. So I understand that. But at the end of the day, the long term wins out. So it's good and it's key to find technical levels, support, resistance. But things like this are going to tell you why a stock broke support, why a stock broke resistance, why a sector is getting profit taken, why another sector is getting ran to, where in February and March and April, you might not have understood why tech is getting hit so heavy, but the S&P is running, but the Dow is running. You feel me? So these are the type of things that we're not just telling you this just to do it as tedious work. It's honestly to help you learn and get that repetition so that if a stock comes across your way or somebody tries to tell you about a stock, you know how to do the research for yourself to make a well-informed decision to, okay, will this play out long-term? If it will, why? And if I want to play it, what is going to make this trade go left? What is the possibilities that could happen economically that will prevent me from being able to make the type of money that I want to make, or, just letting the trade to even be able to play out? You feel me? Because interest rates rising at the beginning of the year was a super red flag that I was not fully, I wouldn't say aware of, but I wasn't fully understanding of the detriment that would have to the tech sector and a lot of the high flyers specifically. But if I would have did something like this or had this information, I would have knew, okay, if rates start rising, I might either need to close out my tech, I might need to readjust and go to something else, or even just hedge instead of doing puts. I might could do some calls on some XLU or XLP. So this helps you develop a strategy where if you was to do an analogy as like a basketball player, instead of just doing layups and jumpers, now you add in a crossover. Now you add in a no-look pass. Now you add in, just different things to your arsenal. So you're not just an average retail investor that can be taken advantage of with the swings of the market. You're more well-informed. So even if you do take a loss, you even have a more understanding why you took that loss, how you can get it back, what's next to play. Oh, tech ain't running. Let me look over here. I've been had this XLU stock. I've been had this utilities or this staples play sitting there waiting, to play. You feel me? So you do your technical levels on the XLU now. Now you got other moves to make. So I don't want to speak too much because we is over time, but I just want y'all to know I don't give out stuff to have people do it just to do it. If me or AJ tells you some homework to do something, it's truly, truly for your benefit so that you can understand the long game and not get discouraged by the swings of the market.
Facts. That's it.
That's it.
Really that simple. We're just trying to make y'all assassins out here, silent killers out here in this market, you know, having that overall macro view, not just looking at just the market from one view, which is tech only. So y'all already know this is what Sector Sundays is about, you know, learning the sectors and understanding the market from all angles possible. So we appreciate y'all rocking with us tonight. Like we said, we ain't gonna hold y'all too long. So we encourage each of y'all to keep learning, keep doing your homework. And we love y'all. We appreciate the support.
No, we definitely appreciate y'all. Appreciate y'all showing up, staying here, tapping in with us. We know it's a Sunday. We know it's other people doing other things. So everybody that showed up, definitely appreciate y'all. If you know somebody that need this video, send them the link, tell them to run it back, take notes, come back. Like I said, I'm gonna do timestamps on it. So if you want to jump to a specific sector, I'm gonna have that timestamp for you. You're not gonna have to keep doing that on your phone to fast forward. It's gonna be right there for you. But yeah, we're not gonna waste too much time, y'all. Sorry for being late. Not really, but you know, we made it anyways, and we hope y'all enjoyed this. If there's anything we could have did better or anything y'all want to see in the future, definitely let us know. September 12th will be the championship. FT&T, Leah and Dave versus David. Make sure y'all tap in for that, man. These are some true analysts. I'm gonna call them analysts. They ain't even cuzzos no more. They analysts that do this for free for us. You feel me? So make sure y'all tap in with that. Show them love. Outside of that, AJ, did you have anything else?
I mean, I'm sure they caught your story, but we'll leave them with a little gem for this week. Tell them check out ATVI that we did on Sector Sunday Breakdown. Run that back right quick.
Man, run ATVI back. If you in the Facebook group, it's in the Facebook group. Go take a look at ATVI. Go look at the bull bear case. It is a little dated. So do your own bull bear case. Take a look at the analyst targets.
Yeah.
But really take a look at that stock. I'm not telling anybody to jump in. I'm not telling anybody to go crazy. In all transparency, I do have a couple positions in it. They're not, a significant portion of my portfolio, but I do have a couple. I have a June 22. I have a January 22. I do have a couple positions in it because, it looked good to me. We might have two different lenses. I think my wife is the most beautiful woman in the world. You might think she ugly. It don't matter to me, but you feel me? It's two different.
Listen, good night. We saying good night.
But yeah, check out ATVI. And on that note, we gonna get up out of here, y'all. Appreciate y'all.
Peace and love, y'all.